Hello, everyone. How are my trading warrior brothers and sisters doing today? So, I'm not sure what lit up. Good morning. How are you, Brock, Amit, Sean, Shahab? How are you? Everyone doing okay? Okay. We're having some technical difficulties with the broadcast.
No, we don't. It's absolutely fine.
Okay. Okay. I thought
Stelios
can't hear. He can hear me now.
Okay.
All right, beautiful.
I'm here. Good morning.
All right.
Good morning.
So today is the Day of Atonement, and we're going to talk about slavery, which is debt. Okay. In the old days, they had what was called Jubilee years, where all debt was forgiven, and it gave people a chance to start over. So the U.S. budget is going to be a topic that we're going to be discussing. I just want to run over a few technicals before we get into that. And Euro held.
Coach, don't forget that Blake is absent. So
right.
We're going to use his part of the time to speak about a few things that are quite important. They become quite important with the developments, especially that we had yesterday. I mean, the expected, in essence, denial, so announcement of continuation of QE.
Oh, okay. What lit up the S&Ps? Is that what lit them up?
For sure.
Okay.
For sure. Why
did it happen? Okay, go ahead.
It was also, once again, an announcement that the Chinese might be buying more agricultural goods.
And they might be open to a partial deal, they said. So that's...
Yes, so it was like that. But still, the reversal from the lows began before we had that news. Began with Powell's speech. So I'm pretty sure that the main catalyst has probably been that.
Because it was a pretty ugly close yesterday, and Powell had already spoken. Isn't that correct?
We had an initial reaction higher, though, after he spoke, and then, yes, the markets pushed lower again.
Oh, okay.
Then they digested more the information. We also got the news that Stelios just spoke about, 10 more billion.
China.
From China, and supposedly, and they say supposedly because all of us have read the same news again and again, and speculation and rumors. We've seen it again and again, both, for Brexit and the US-China deal. So personally, I'm taking everything with a pinch of salt, the least to say, right?
Yeah, I would. There is a fact, though. China does need pork. There was a virus that decimated their pork population, and that's a main protein source for the Chinese, more than beef.
Oh, trust me, I know. We had an increase in prices here in Europe
in pork
because China was importing huge quantities of it because of that. So I know exactly what you're talking about.
Yeah, I think more than half the hog population was slaughtered. Okay.
Yeah, that's true. It's amazing.
So in China, anytime they've had troubles, it's been because of famine and food problems. I mean, you want to get a population up in arms, let them get hungry. Okay, so anyway, I think they do need to do something on the agricultural front for sure. That is a need and not just a negotiation tactic. And we know that they need that. So anyway, before we get going, I think that what Euro did last night is important. And if you're bullish Euro, I don't think you want to see it take out this 109.40 level. I had a blue horizontal line here, and that was a pullback area I was looking at from this weekend. We still have to do more to the upside to prove it. I was looking for lower levels in yen. I thought I'd have a chance maybe down here. Anything can happen, but it's starting to look less likely. We start closing over 7.5. We get to 8.5, and the yen's really going to squeeze. And part of that is I'm top picking TLT, which is an ETF on the 20-year bond. Yesterday, even with the big sell-off, in TLT, we were unable to take out Friday's high. So I'm thinking maybe I'm early. I'm wrong over the highs here because we'll go to 150 or better, but I'm thinking we could be setting up a C wave decline, which means that yields, which were on the verge of making new lows yesterday, Steve and I were talking about it when he was doing his review, so far have held. And if we start getting back over the 160 level on the 10-year, we could have something like this from here, which would take it to 2%. And if you really want to be contrarian, you would look at this wave, which was, you know, close to 50 bips, and take 1.618, and that's going to be 80. And if we had 1.618, and, you know, that wouldn't even change the trend. Okay, it could just be a bear market rally back above 2%. 1.618 is going to be about 220. Okay, which was another major breakdown. But I think they're going to go for the 2% handle. And if they don't make new lows this week, I think this is what's going to happen. I don't follow the Bunds, but you know, that chart looks so ugly to me, even though Steve says there's more of a retrace for an ABC. I'm kind of bearish interest rates here. It's probably one of the more contrarian trades on the board. Also, I don't know what you guys think. It's probably more crowded than the long equity trade. And so I think, you know, markets go to where they could shake out the most people. And I think there are an awful lot of bomb bulls that could, you know, see drawdowns. And there is an analyst that I respect on CNBC. He's one of the only guys. There's a few that when he's on, I listen to him. I turn up the volume. Carter Worth. He's conventional, but he's, you know, experienced, and they call him chart master. And he showed a utility chart that looked pretty heavy. He's thinking, you know, not a bear market beginning, but utilities could correct 6 to 10%. That's the defensive part of the market. So those are my thoughts coming into today. And I don't know, was there anything else? Crude, we'll see. This is crude's chance to, you know, do something right here. I was looking for a little lower to try it. And then this was something else I saw yesterday. I don't know if Steve's going to agree. Maybe we continue, but this sure looks like ABC with a washout to come, which will make silver the preferred long over gold. Okay, so here's your gold silver ratio. And CAD yen is trying to dig something out over 82. It's going to look pretty good. So maybe we have risk on again. It certainly came off quite a bit. Where was that candle? I think it's a daily I have. Yeah. No, I think it was this or this. No, it was this. So we came off those highs, but why can't this be A, B, and if we had something like this and rates firm up, equality from here is going to take you back near the highs, right? This was a over 100 handle recovery, or 100 handles. So 100 handles from here, quality would take it to 29.86 up here. So it wouldn't be a new high, but I think that's a possibility. So any questions on anything I've said? Oh, Sean has some more jokes. Okay. So I have one for you, Sean. You know, everyone's complaining, and Steve has talked about the quality of leadership, politicians nowadays in the world. And, you know, everyone says, you know, where are all the Washingtons and Jeffersons when you need them? Do you guys know where they are?
In the graveyard.
In the NFL. You get paid more. Anyway, nice so you like it? Okay, so anyway, I hope no one takes offense to it. It's just a joke. There's no racism in it or anything, but we could sure use a Washington or Jefferson right now. Right. So anyway, what happened overnight? Any news,
Yes.
Dale? Go ahead.
Well, we had Jay Powell spoke yesterday, and he said there's gonna be a resumption of asset purchases, but it's not gonna be QE.
So, do you remember what I was saying yesterday during the webinar?
You said it yesterday. Yes, exactly. So
I said it a week ago. I repeated it yesterday, like I knew that he's going to say it yesterday. I didn't know he was going to say it yesterday, of course, but I knew it would come.
Yeah.
Well, I call it WTF money.
Yeah, QE is now a tainted term. Why? Because they used it and they advocated for it in front of Congress, Bernanke did, as measures to save an economy that is in big trouble. So they're going to be doing the exact same thing. They're going to be increasing reserves by naming it differently because, they can't give them the same name because everybody's going to be like, okay, so why are we going back to measures that were meant for a period of crisis? Is the economy in a crisis? Are we headed for one? Are you trying to prevent one from happening? So back to QE, and we're going to name it differently. Now, Powell claims, if you heard him, that the new expansion in reserves, which is exactly what QE is going to be what the Fed would normally do because the Fed was always normally expanding its balance sheet. Now, let's dive back to history a little bit. Between 1913, when the Fed was created, and 2008, when they acknowledged that the economy was in a crisis, so they started, cutting rates and doing QE and everything else, the Fed had accumulated an 800 billion in its balance sheet. 800 billion. During the last 3 weeks, this normal expansion that isn't QE accumulated 180 billion. So you can be a judge for yourself if accumulating 180 billion in your balance sheet within 3 weeks is normal expansion of balance sheet as every day's work.
You could argue that inflation adjusted it's a much bigger amount, but still your point is valid, and we've seen a very different situation after the 2008 crisis, which is not stopping, right? We had a brief pause, but really it's not stopping. So I agree with you 100%.
We came down to 3.7 trillion. They managed through quantitative tightening to take the balance sheet from roughly 4.5 to 3.7. And we're probably going to be, by the end of this week, back to 4 trillion. I think it's almost inevitable that by the end of this year, and if not by the end of this year, I mean, there's no point to argue with that, within the first couple of months of next year, the Fed's balance sheet is going to be at new all-time highs above 4.5 trillion. So the question now is the following. Is there anybody that claims, I mean, we've been saying that in advance, that quantitative easing as a policy tool wasn't a failure completely? Not only because we have started going back to it, but the success of quantitative easing was predicated on one and only one assumption. What Bernanke said in front of Congress. This is not permanent. We're not monetizing debt. It's going to be short-term. And once the economy is back on track, we're going to unwind that from the Fed's balance sheet. So now with quite high confidence, we know that the most they were able to take off the balance sheet was from 4.5 to 3.7. You can do the maths. That's 0.8 trillion from the 3.7 trillion or whatever it is that they had to accumulate. So question, Was the policy of the Fed successful? Answer, they've already given that to us officially yesterday. Of course, we knew in advance. No. Question, why isn't this any more debt monetization, since we know that the only argument that Bernanke had to say that this is not debt monetization is that it is only temporary in front of a situation that is the worst situation that the US economy had found itself since the Great Depression of the 29 and 30s that followed a few years in the 30s. So now we know the answer to all that. Now, question, why are they doing that? Is the US economy actually going into a crisis? Answer, I've already answered that before. The US economy is already in huge crisis. How do we know that? And now this is time to do some very, very basic maths that all of you can follow. So how do we know that? We know that because last year, the US, and all that is official numbers, you can check it out, had an official deficit of 779, if I remember, let's round up all the numbers, so 780 billion. The problem is that in order for the year to be over, the US had to borrow that much money, roughly, it's rounded up again. So the actual deficit, because the rest are of budget items and it's just window dress, was 1.4 trillion. Now, today, we got this, and you can read it here.
You want to take the charts, Steve?
Sorry?
You want to take the charts?
Oh, sorry, I forgot that I don't have them. Yeah, my mistake.
No, I'm
absolutely.
Not saying, just so I.
No, thank you very much. That is why.
Steve, let's remind ourselves that when Trump, before he took the presidency, he said that he's gonna aggressively reduce the deficit, and he's actually increased it by like 50%.
Stelio, that's not only what Trump had said. And Trump, as most politicians, they promise something and they deliver something different. I mean, Obama did the same. So it's my comment that it isn't, pro-democratics or Republicans or whatever. So read the first paragraph. The federal budget deficit for 2019 is estimated at 984 billion, a hefty 4.7% of gross domestic product, and the highest since 2012, the Congressional Budget Office said on Monday. And then they move on to say that the path is unsustainable, and sooner rather than later, the US is going to have a huge problem in servicing that debt. So what you couldn't see before, this is the official budget from last year. This is the official amount, though, that the US had to borrow to finish up the year because of budget items. Now, don't ask me why an economy does so much of a window dressing. I mean, why you need to have an official budget deficit of 780 billion and need another 420 to, off budget. But, it's a different story. You all understand the answer. Now, we get officially that they expect the deficit to be this year 984. So let's see in analogy, how much would they have to actually borrow this year to make it through the year analogically to the data we know from last year, okay? So the number comes out to be this one, okay? Now, what percentage is this of the US GDP? The answer is 8.6%. So the budget deficit for this year, the actual budget deficit, because the official is going to be roughly 5%, is going to be 8.6%. Even if you don't want to accept this number and this number that goes there, and you only want to accept the official budget deficit, but this number is also official. It's officially how much the US had to borrow, right? So it's not a number I took off my head. So, but even if you want to completely ignore that, so because you think it's irrelevant how much the US has to borrow to finish up the year, we still have an increase of 25% in the deficit in a year. 25% increase in the deficit. So we're talking about the US running an actual deficit of roughly 8.5%. Stelio, what is the highest deficit of any country in the European Union at the moment?
I don't know. Is it the?
Do we have anybody above 3%? I doubt it.
I think Italy was around 3%, right? So it's somewhere around there.
Italy, which is probably the worst, is around 3%, and we have countries like the countries that were doing worse. Portugal will have a budget deficit of 0.5% this year. If you don't want to take my word for it, you can check that out in articles like this, for example. Right? Greece has a primary surplus now. Germany, France, etc., they run a deficit of around 2%. So you get the point. There is something else there. You said that Trump promised to decrease the deficits. The deficits have been skyrocketing. What else did Trump promise having to do with US numbers and the US economy? Do you remember? That has to do with the debt. Let me help you out. What did he promise to do with debt maturities?
I actually don't remember. What did he do? He said,
he as a candidate, he was saying that it's very, very stupid that the US has such short maturities. And if he was president, he would make sure that the US extended maturities, taking advantage of the low yields. Do you know what has happened to the debt maturities under Trump? They have become even shorter. So they are on a binge, borrowing shorter and shorter term to make sure that they borrow at the lowest cost. But that puts the US in a huge, huge risk. Imagine it's like having a mortgage, which you have to remortgage part of it every month. I roughly estimate almost 1 trillion of US debt has to be re-rolled monthly. Can you imagine that? On a monthly basis, the US has to re-roll roughly 1 trillion of debt. So what's going to happen exactly if at some point the Fed loses control of interest rates and they go higher? Can you imagine what that's going to mean for interest repayment?
Well, the thing is that we've talked about this in the past, I think. I personally think there's near zero chance of a default. I think what they're going to do is
there is zero chance of a default because all the debt is in US.
Yeah, so the old trick is inflating it away, devaluing your currency, and just keep moving on.
Yeah, exactly. But of course, that's going to have a cost, right? It's going to have an actual cost because one way or another, the honest or the dishonest way, people are going to suffer, right? No matter which way they choose. So I would love to hear anybody's counter argument, but actual argument with numbers, with data, explaining to me why the US economy is actually the lighthouse in darkness, the steam engine of the global machine at the moment, etc. From what I see around me in Western world, the US is at the moment the weakest link. There is only one thing going for the US, the fact that the US dollar is still the global reserve currency. And that's the only thing that keeps on the Ponzi scheme going. We have now an official admission that the Fed's policies have failed. We're going back to QE, and from the looks of it so far, in a much more aggressive manner than we've had in the past, while they officially still tell us that the economy is doing great. Let me remind you that in the middle of 2008, the Fed was still claiming that the economy is doing okay. And by revising the data, we found out that the US was in a recession since the end of 2007. So good 6 months into a recession, the Fed was claiming that the economy is okay. So you can draw any lines and make any analogies that you wish. But I really want to hear anybody explaining to me why they think that really the US economy is doing well. The global economy is in a mess, so it's not only a US problem. The monetary policy, the global monetary policy of Western world is a huge mess, and mostly what creates the issues that we're seeing around us and what creates the big booms and the big busts that follow them. And, it is what it is. So can you trade with that? Probably not. I mean, logic says that after yesterday's announcement, the dollar should start a steep decline lower. Will that happen? Probably the exact opposite is going to happen, because usually that's how the market responds to fundamentals and data. initially it wants to prove that they don't matter at all. So I wouldn't at all find it peculiar if we see like a big dollar rally. But we know one thing for sure: fundamentals act like gravity. You can initially try to escape it, and you might, assume you're doing so. If you're Michael Jordan, you can feel like you're flying for a small period of time as, you're on your way in, doing a magnificent dunk, but eventually gravity pulls everything down to earth.
Not Michael Jordan. No. All he had to do, you could hang on to the rim when you're up there,
Steve,
right?
Steve, I've had this conversation and this argument with in the past, and the common answer always is, but look at the rest of the world. Look at the Eurozone, the UK, Japan. They're all running deficits, and why should the
okay? Let's take the example of Japan.
But
Japan,
it's a relative thing, right? It's in relative terms. Who's doing worse? That's a question.
Yeah, and I can tell you the US isn't doing better. For example, you mentioned Japan. Do you know that Japan is the biggest? Many people believe that it's China. It's the biggest creditor of the US. It owns more than 1 trillion of US debt. How much?
They also own a huge amount of their own debt, right? Japan.
The vast majority, actually. And that's why Japan is not being punished by the markets, because the vast majority of Japanese debt is internal. And that's why the world isn't worried about it, because eventually they'll have to write it off, but that's going to affect them. I mean, for example, their pension fund, which is like huge, owns a huge chunk of that same debt, right? So Japan owes Japan a huge amount of debt. That's not our problem. I mean, that's not the US's problem, and it will probably never become, etc. At some point, they're going to have to write it off. But that's going to be something that's going to stay internally in a big extent. And that's why the market is so forgiving in a debt that is nominally, what is it, Stelio, now? 240, 250%? Something like that.
Well over 200, yeah.
Yeah, but that's not the case with the US. Also, Japan is an amazing exporter. They make amazing goods. I mean, they export all over the planet. Germany, the same. So, if you take qualitative data, I mean, the difference is obvious for anybody that understands economics, right? So, this is the situation. And that is why I think that, the US dollar rally doesn't have a lot to run ahead. I don't know how much it's going to be. It might be months. So I'm not advocating anybody should be short dollars at the moment. I mean, the dollar index at the moment, it's still in an uptrend. There's no question about it. But keep in mind, I wanted us to have this discussion at some point. And, I wanted us to also, go back and see Fed's history and everything else. We're not going to do that today. We're going to go back to the charts. But this is the fundamental reality and the fundamental truth.
Can I apologize to our American viewers who are probably going to be having nightmares tonight from what you've been saying?
No, I don't think that any. I mean, it is a reality that's going to affect all of us, because what remains true, though, and that is the truth, is that when the US catches a cold, everybody else catches a pneumonia, and I'm afraid that the US is about to catch a pneumonia. So we need to find out what that would mean for the rest.
Cool. Well, actually, probably worth mentioning, we talked about the US debt and everything, probably worth mentioning what the market's pricing going forward in terms of rates. And, Powell has been a little bit defiant recently over which way rates are going to go. He hasn't been overly dovish, although, he did that 180-degree turn in late 2018. But it's worth mentioning that in the October meeting, so late this month, we're pricing now probably around 20 basis points. So, 80% chance of a cut, and which I think is going to be done. I mean, that's going to be priced 100, I think, very soon. And then from then on, let's see, until, let's say, the end of 2020, 98.36, we have another 60 basis points or so. So another 2 and a bit more until the end of next year, which, I still think the market's getting it right. The market's been going ahead and pricing cuts, and Paolo has been saying, oh no, this has been just a mid-cycle adjustment. Yes, and then we do another adjustment. So the market is right, and like we've said before, the bond markets are usually right. They're usually the first to act. So
the first to act is always the bond market, then FX follows, and stocks are always the last ones to get the message. Yeah.
You sound like you've read Martin Pring. Do you know of him?
No.
I haven't.
No. Okay. Yeah, he talks about the progression. It's always the bond market before the stock market.
Well, I used to sit
commodity. Go ahead, Stel. Sorry.
No, I was going to say I used to sit right next to the treasury traders at Merrill Lynch, and I could see what they were doing, and they were first in always.
Of course. Now, Gautam here says the economy is only in a mess because of Trump trade situation. Once this is resolved, which it will be before election, the global economy will recover. Stock markets will be supported and are hanging in there despite all the negatives you state because of this. Stelio? All problems with the trade deal?
Well, it is a good point.
Well,
I mean, it's not, who knows? Look, the rubber band can stretch further than all of us think. Okay, I know because I bet against the rubber band thinking it would break. Okay, so, it is possible. Who knows? They could elongate the cycle another year or two, not 10, but maybe another year or two if they solve the trade situation.
The thing is, if we look at the pattern, what Steve has described started way before 2016. And also, if you look at equities, what have they been doing for the past year or so? They'll be clinging on to any kind of positive comment, trying to pre-price a deal that might come. And we've said this in this webinar in the past. I think that when the trade deal happens, which I think it will eventually, it will be a sell the news event. It's going to do one last hurrah, and then that will be it, in my opinion.
And you know what? The leadership, Stel, of the last 2 years, the FANGs, they are so way underperforming the market now over the last 6 months, even though the market has recovered. A lot of the FANGs are 20% or so off their highs.
Not only those, all the unicorns. Have you seen how
all the IPOs
have been performing? Do you know why that's the case? Because even dumb stock investors, I didn't just call all stock investors dumb. Even the dumb of the stock investors.
The dumb money? Stop talking about me during the webinars like that every day.
Even the dumb money have started realizing the following. The Austrian economics calls that malinvestment. It's when very, very low and inappropriate monetary policy misallocates factors of production, mainly capital, in purposes that should never be funded. So we've seen that back in the past. What would happen if somebody had a nice idea about a business? They would get some initial funding at a very high rate, or they would fund it themselves. They would prove that a business idea can be profitable in a smaller scale. And once they did that, then they would IPO a company saying, look at this, guys. We had a good idea. We made a company that can make money in a small scale. And if you give us your money, taking advantage of the economies of scale and the fact that we've already proved that this idea has merit, we're going to give you back your money and more. And then they got IPO'd. What do we see happening since the craziness of monetary policy began? Companies that have never proved they can make a single dollar,
Uber,
get funded like crazy. They raise huge amounts of money,
billions in market cap, without making a penny.
Without making a penny. Not only without making the penny, without even showing that there is a trend to reduce the losses, the yearly losses.
I think,
So,
Steve, I think this is happening because people are trying to anticipate who's going to be the next Amazon, Facebook, or whatever, those startups which initially might not be, obvious how it's going to work, but eventually they just take off.
Stelio, the thing is, due to malinvestments, what do we have in this case, which is good for the consumer, by the way. Keep in mind, this is one of the reasons that the huge inflation we have, keep in mind, inflation, according to theory, is the expansion of monetary supply. So this is not a debate if we have a huge inflation. We do. Now, one of the reasons, not the main one is because, for example, the US exports inflation to China, let's say. One of the reasons this has not translated so much in the increase in prices is because all these companies, the consumer is being subsidized by stupid investors. So investors tell companies, listen, you can go on losing money by offering a product at a lower price than it actually costs you to produce it. And we're going to keep funding your losses because we believe that in the near or not so near future, we will manage to actually sell stocks to your company at a bigger price. So it's as simple as that. Stelio, any disagreement there? Any different point of view?
No, I agree with you 100%. I don't have anything else to add, really.
So, the whole situation is a huge mess, right? And this is exactly, what we have to deal with. Anyhow, back to the charts. I on occasion, I think that, speaking a little bit about economics is good. And unfortunately, people that, listen to the media, they get a total different idea of how an economy works, because it's in essence a huge propaganda to make us believe that, for example, high inflation is a good thing. Oh my God, it's horrible if you don't have inflation. I mean, how are you going to live with the value of your money, not going down every year? They try to persuade us, for example, that low inflation might be negative for the economy. We know that as a fact that it's not the case, but they need inflation to, inflate away the debt. So they need to persuade us that there is value in inflation for the consumer as well. There isn't any. Okay. So a lot of economics being taught in universities, trust me, I know. I went through a university and got lectures on economics, right? Are Keynesian. I'm not going to say the word. Okay. Anyhow, don't trade using all that, because, doom theories or, theories about reality are not going to make you any money. But you need to be aware of, the big picture, right? In trading, at some point, that's going to be useful as well, but not yet, because, the economy keeps ignoring, the financial markets keep ignoring all that information. And what we have for now is a sustained uptrend in the DXY. Going back to the charts, you can see it here. We're still stuck in this ascending channel. You can see it if you look at the blue one, in this little ascending wedge. If you look between the purple line and the red intermittent ascending trend line, etc. So there is, nothing that has changed from a technical perspective having to do with the dollar. Dollar remains very decently bid, and the same applies. Doesn't matter what the reason is. If it was, the Powell's, in essence, denial / confirmation of quantitative easing, if it was hopes again that, we will indeed have some kind of a deal between US and China, what remains true is that we have this ascending wedge. You can see it here in purple. And once again, yesterday, the S&P held that support. Now, if you want to be a little bit more prudent here, I would also take into account this horizontal support area. You can see it's the 61.8% fib of this last move higher. Also, the 200 daily moving average is there, and it's a horizontal support resistance area. So triple confluence of supports a little bit below this ascending wedges trend line at 2860 roughly. So I do think that 2860 is going to be a key level that if we break below it, I think there's going to be a lot more losses coming for US stocks. I mean, In all actuality, I believe that if we go below and if we close on a daily basis below 28.60, there is a very, very good chance that we're going to end up completing the ascending wedges target. In all cases, theory tells us that an ascending wedge should completely retrace the formation. That would mean a move back to 2,334. But as I said before, 28.60 is the level that needs to be broken, and we need to close below it in order for me to believe that we've started moving towards that objective. Until
Steve,
that happens, yeah, Coach.
I'm just curious. We get here in the U.S. Two sides of the coin on the impeachment coverage. Fox News and CNN, MSNBC on opposite sides. It's not news. It's kind of like editorializing everything. What kind of press is the impeachment getting on, in Europe? What are they thinking? What are they saying? Do they believe, what kind of, what are you hearing from Europe?
Well, depends on the country. In general,
like BBC, I used to listen to BBC sometimes. I don't get it anymore. I'm just curious how you guys are looking at this impeachment as,
Trump doesn't have many fans in Europe. Let's start by that. But don't believe that people really care so much about what's going to happen.
They don't care.
With the impeachment. They don't care. I think that nobody cares enough until it becomes a very, very real possibility. And I think we have some distance from that, right?
Okay.
We're still at the very, very beginning of what might end up being, an impeachment process.
Yeah, there are a lot of people predicting he'll be reelected, and that's a contrarian bet. But,
I can tell you one thing for sure. I think with how the economy is doing, the
where the market is.
Question. Would you close your eyes and be long this market for a year?
I can't close my eyes for an hour unless I'm sleeping. I have to walk away. In fact, remember, I used to do that. Oh, Mrs. Pinkert, please take the mouse away from me. Please put it in the wall safe. So, but I know what you're saying. So really, the way to forecast the election, just like the USD won, is kind of a trade war. The S&P will dictate it.
The chances of Trump getting reelected are almost zero if the economy has failed by then.
How about Powell letting the air out of the balloon into next November?
Powell, so far, despite Trump's frustration with Powell, can you name a single thing that Trump has asked from the Fed, and the Fed with a little bit, but not a lot?
We didn't go to zero.
Delivering.
Trump asked for zero.
We are on our way to zero.
Right.
We started 3 weeks ago quantitative easing. The data on the balance sheet are official. The data on the balance sheet are official. You can Google it and find out that the Fed's balance sheet bottomed out 3 weeks ago, and it's been moving frantically higher since. Yesterday, in essence, he confirmed that we have quantitative easing, but oh God, it's not quantitative easing, it's something different. But, there was no denying that, they're now officially, they have declared that they're expanding the balance sheet, but they won't name it quantitative easing. That's the only difference. So what has Trump asked of them, and they haven't delivered? You understand that there is, even the most
Paul knows there's a lag time to anything they do. Like right now, some of the people I've interviewed, what we're feeling now
that is very
true. QT from 2 years ago.
That is very true, and that is why it really doesn't matter that much if the Fed starts cutting by 50 basis points or 25 basis points. And actually, if you want my point of view, since what the Fed is going to be doing today is not going to matter much tomorrow, but it's going to take some time to take effect, as you said.
Yeah.
If the Fed expedites rate cuts, it's probably more going to send an alert signal to the markets than help. That's my point of view.
Okay.
My point of view is that Trump might want rates to go back to zero, but you are a very experienced guy in the markets. Tell me something out of curiosity. Let's say that 30th of October, Powell comes out and says, okay, we're cutting down to zero from where we are. That's it. Down to zero immediately. What do you think the market's going to do?
It'll create a panic.
Exactly. So Trump might be asking for zero rates and quantitative easing. He already got the Fed from saying they're going to hike 4 times
Right.
to
True.
cutting 3 times in a row, right? And they restarted quantitative easing in a bigger pace than we ever had. I mean, they've done all he has asked for, and if they actually ended up doing more, they would create havoc instead of helping. So if you're asking me, I couldn't imagine of a much more friendly Fed's stance.
Okay.
That's my personal point of view.
Okay. But what they're doing now may not really filter into the economy till 2021.
Do you remember our friend that you brought the other day here,
Yeah.
that he was showing that historically we get all the rate cuts while the economy is tanking
Right.
and stocks? Yeah.
Okay.
So
Yeah.
I have no reason to believe that we're not going to have, a replay of the same.
So every time they do it, you get a bear market rally that fails, and then we go to new lows and they do it again. That kind of pattern.
One thing is for sure, we know as a fact that the Fed has never been smart or proactive, right? I mean,
yeah, they make mistakes all the time.
Actually, all the mistakes are theirs. Even the fiscal mistakes of governments have to be owned by central banks. Why? Because they enable this reckless behavior by trying to take the burden in the part of monetary policy. If central banks did not enable governments to be fiscally irresponsible, not only we would have much more appropriate monetary policy for economies to thrive in the longer term, but we would also have politicians having to own the decisions and the side effects and the repercussions of the decisions they take immediately and not in the future, right?
Mm-hmm.
So that's the huge problem with the way monetary policy is conducted right now. And since the conversation came to that, the Fed was created in 1913. Do you know, Coach, that Congress made sure that it was illegal for the Fed to own any US debt instrument? Any. Because back then they realized the danger, the huge danger of having a central bank being able to monetize debt. And they didn't want that. So what they did is they forbid Fed to own in the primary or secondary market, right? Mm-hmm. Any US debt instrument. Do you know when that changed?
Nixon?
First World War. Because they needed the money, so then they decided.
Didn't last long.
A lot of people don't know that, and history is very interesting. And then they decided they want to take money, but they didn't want to increase taxes that much. They did that as well. So what did they decide to do? They decided to allow the Fed to buy US debt instruments in the secondary market to help out, right? Mm-hmm. And what did they do to counterbalance the possibility that that will end up in a reckless long-term debt monetization? They imposed the debt ceiling. The debt ceiling was imposed then, since they were now allowing the Fed to buy debt instruments of the US to make sure that that's not going to be used to run debt, to the sky. So they imposed the debt ceiling.
Disciplined. Yeah.
Yeah. And we all know the history of the debt ceiling. So in essence, the Congress initially had the right idea about the Fed. The Fed should not be able to monetize debt. Then the First World War came. They decided that they need a little bit of help, so they're going to allow the Fed to do that. But we still need to put some kind of a barrier. What is that barrier going to be? The debt ceiling. And then the debt ceiling became a joke. So even going back to history, you can already see that the initial intentions have been violated, in the most obvious way, right?
Yeah. Interesting.
Yeah,
how long is this semester, Professor? When's the final?
I'll see. I can make something for you.
All right. In college, one of my professors said, I probably said, what's worse, ignorance or apathy? And I responded, I don't know and I don't care.
I know you've told me that. That actually is an amazing story.
Yeah.
Okay, back to charts. A lot of
Charts.
history lessons today, but I do love financial history.
You do. You're very passionate about it. And you know what? We all learn. I mean, I didn't know that was World War I that was the catalyst for that. So,
by the way, World War I brought to you Americans also two taxes, right? Because of that. Gift tax. No, income tax came in 1913, since you're asking about it.
Okay, with the Fed. Okay.
Income tax came more or less with the
Boy,
Fed.
They were busy in 1913.
Yeah, and initially a lot of people don't know that, but the income tax in 1930, if I remember right, had only two brackets. One of them was 1%. 1%.
Huh.
1%. And the biggest one was 6%.
Oh,
now,
gosh.
the fun part. In today's incomes, to even go in the bracket of 1%, you needed to earn something like $80,000 in today's money. So up to $80,000 of today's money, you paid zero income tax, zero.
Right.
And above that, until an equivalent income to today's 1.3 million, you paid 1%. And if you made more than today's 1.3 million, then you had to pay another 5 or 6%. So that was it. That was income tax in 1913.
That was fair.
Yeah. Now, compared to today, right?
Yeah, this is, no upward mobility because of all the bricks on everyone's back.
And that is also a little piece of history as well. In order to persuade people to be for the income tax, which was illegal and against the Constitution, they had to amend the Constitution to do that. By then, the US was collecting most of its taxes through, guess what? Tariffs. But they only had that, tariffs. So they persuaded the people to be for it, saying that, listen, we're just going, and tell me if that reminds you of something.
Oh, yeah.
We're just going to tax the rich a little bit, so poorer people can get rid of the unfair regressive tax that is called the tariffs, and people were for it.
Yeah.
Now, back then, it was indeed only the rich people that paid that, and that is why you need to think twice every time you hear, "Don't worry, we're going to put a new tax that's only going to apply to the rich people." I'm not against taxing the rich as a general rule. But can you give me one historical example that the taxation didn't begin, let's say, from a higher bracket and didn't end up creep lower and lower and the rate increasing and increasing? So in the past, every single time we had a temporary tax coming through, because the vast majority of the taxes are coming as temporary. You remember the victory tax, for example, in World War II? I mean, you weren't alive, but I mean, if you remember the past.
Oh, yeah, I was.
Yeah. So, we always get taxes coming in as temporary. They mostly come in as, don't worry about it, it's only going to affect richer people. And year by year, government becomes bigger and bigger. It needs more money. So what does it do? It increases the rate of taxation and it lowers the income barrier for which it starts affecting people. So initially, a tax that really affected people that made 1.3 million, because the 1% is negligible, in today's money back in 1913, coach, what is it, $10,000 today? The income tax begins at $10,000. Am I right on that?
I don't know. I have a CPA.
Anyhow,
I really don't know tax law.
I think it's $10,000. So just think about that. 1.3 million in today's money became within 100 years $10,000.
Wow.
So cable, we have a question about it. Cable is stuck, as you see, for second consecutive day at the 61.8% fib. But it doesn't look good, I have to tell you that. I mean, this looked to me like a corrective bounce. I mean, from a bearish perspective, you have to like the fact that the rebound to 123.70, 123.80 failed. And we're testing the lows once again. I mean, these lows again. So I have to tell you that it doesn't look good to me. I mean, it looks like cable wants to continue lower from here. Okay. So that's what I think about it. Now, euro is looking better, admittedly. Now, would I be bullish the euro? No, I wouldn't be anything the euro. Coach showed very correctly that euro retested the soft support line yesterday, and it is rebounding from there. But, you know, in order to have any kind of an advancement, I would want to see this descending trend line resistance break to the upside. So I would want to see a move above 110.20 roughly, and that would open the door to retest this previous high and horizontal resistance area at 111.10. So, you know, a lot of resistance areas that the Euro USD has to go through before I become, you know, bullish about it. So far, we see a clear RSI divergence on the daily, but, you know, no resistance area has been broken yet. So we've seen also this divergence between what the bonds are doing and the US Treasuries. So, I mean, we have some indications that the Euro USD might start rebounding from here. But, you know, I need to see at least something broken to the upside, right? Before that happens, you have to respect the fact that we remain in a downtrend for, you know, so long. I mean, yeah, momentum isn't there and everything else, but we need to see more. So 110.20, you know, the first area that I would really want to see broken before I start becoming more, let's say, more confident that something might be brewing there. I appreciate that most of you appreciate the things we talked about today. I actually thought that we might lose most of the audience, but actually that hasn't happened. So probably it's interesting for you as well. I know it's interesting for me.
Yeah. Well, people also feel you're passionate about it.
Yeah. I mean, you know, why do something if you're not passionate about it? You're not going to do it right.
And a lot of, really, you could be a professor.
At some
I would
point,
I what they call that? I would moderate the class, or what they call it when people aren't in the class, but they come into, forgot what it's called. Anyway, my head's empty today.
Oh, trust me, I felt that many days. So no reason to blame you for that.
The synapses, you know. Go ahead.
We had a question about crude. Crude rebounded from the 61.8.
Audit.
Keep in mind, 50 audit. Yeah,
Ben helped me. Thank you, Ben.
I actually used to do that a lot in economic classes. I used to audit some professors that I really liked. The vast majority of economic professors, I have no idea how the real economy works.
Scott's calling me that I'm brown nosing you, that I'm teacher's pet.
Okay, so crude's rebound so far looks mostly corrective to me. As I said the other day, I would pay close attention to 54.5, 54.70 as resistance. There is a comment about USD CAD, and it's a good idea revisiting USD CAD. Nothing has changed here, but I just want to show you. As you see, the USD CAD, first of all, the long-term picture, USD CAD is stuck in an ascending channel that dates back to 2017. So that is a technical formation of huge importance, right? There's no question about it. Now, within that formation, we've had this triangle, and especially this confluence of resistances, because as you see, this is also the 61.8% fib at 133.50. So it looks to me like it can actually move higher from here, but I need to see 133.50 break to the upside, and even more importantly, close above it on a daily basis before we can say, okay, we have another leg that's starting higher, in which case the next upside resistance would be 200 pips higher at 135.65. Until that happens, we're just stuck in this triangle just above the long-term channel support. So it is what it is, right? I'm pretty sure that sooner rather than later, there's going to be a development here. I mean, mathematically speaking, this is a triangle that is contracting, on a daily basis. So it has to happen. Now, we might need to be patient for a few more days. Okay. We covered the cable. Okay, metals. Now, metals obviously got a sniff of what's going to happen some time ago, right? That's why we had this like big move higher. And as I said yesterday, both gold and silver, here's silver, they seem to be nicely appreciating with what seems to be so far a corrective channel. Now, how are we going to gain more confidence that we have indeed found the lows? By breaking above this channel resistance. Silver actually almost made it to retest it today. I mean, came just a few pips away from it. It's currently pulling back a little bit. Gold has a little bit more of a distance, but not that much. I mean, gold is currently at 1506, and I would need a daily close above 1520. That is a move that gold can easily deliver within a single day. And when that happens, I think that there is not much that will be stopping gold before it reaches its next upside objective, which is the long-term 61.8% fib at 1586, 1587. Okay, so that's the situation with metals. And Coach, you mentioned before the gold-silver ratio pulling back again. Now, it is very likely that this rebound we've seen so far is corrective in nature. I think it's going to be hard for it to go above 88, which is the 61.8, but it is also extremely likely that it might have already found a high, because in essence, it keeps getting rejected from the confluence of the 200 daily moving average and the 50% fib at 86.35.
Sure looks like an ABC to me.
Yep. So, I mean, I think it's worth drawing this trend line, right?
Yeah. Like a flag.
This one, yeah. Let's make it intermittent, because so far we don't know if it has some importance. We're going to find out, I guess, sooner rather than later. So let's clone it, something like that.
Yeah.
Okay. So it's worth keeping an eye on this, on this channel. I think that if we actually clear this trend line support, there is a very, very good chance that another perhaps aggressive leg lower will have begun. And we know, historically speaking, that underperformance of this ratio is generally correlated to overperformance of the metals in general, right? Of the metal complex.
Right. Okay.
Do we have a guest today, by the way?
No. Not today.
Okay,
I was going to impersonate my rabbi, having it be Yom Kippur, and forgive myself and everyone else for their bad trades for the year. Okay, yeah. So forgive yourself, and
I'm pretty sure that we all had bad trades this year. I mean, the market conditions have been awful. I had an amazing first half. But since coming back to vacation, this market conditions, I mean, the market has 3 times, since I came back from vacation, 3 times sent me in the wrong direction with false breaks. Because,
a lot of them.
A lot of them are taking place. So you need to be very careful until we see again the market having more liquidity and taking a direction, because a market that is directionless is very, very hard to trade. Of course, unless you're a scalper, in which case you're looking at charts in a totally
15-minute charts, half an hour.
When you're looking at a 15-minute chart, you can find trends there, right? Because in 15-minute charts, you can find trends. There's no question about it. But that's not my personal trading style. So I have to stick with what I know I can do well, which means that I have to be patient with, conditions being, better.
You know what I've discovered, Steve? No matter the trading style, day trader, scalper, swing, position, the most important word in the English language for trader psychology is next.
Oh yeah, absolutely. And you should never change.
Next.
You should never change what has been working just because you had a few bad trades in a row. That's one of the biggest mistakes that amateurs do.
Everyone write that word down and put it next to your workstation. It'll prevent you from dwelling on a drawdown, and it will keep you in the now for what the market's doing to take advantage of it. Okay? Next.
Exactly.
All right.
And the four more dangerous words are this time is different also, right?
Yeah. You showed how things are rhyming. I mean, every tax is temporary, or we're only going to tax the rich. I mean, I'm hearing that all the time now. So, Steve, you know what? Great job today. And I could tell you were pumped before we started, and you held the audience. And what you did today is a service for people to really think about, instead of 15-minute or even a weekly chart, what, from a historical perspective, where we could be today and prepare for what could come. So, you called that, I call that someone helping people with their stewardship. And so great job, Steve. I enjoyed it today, and everyone else did too.
Thank you.
Okay, so we'll wrap it here. And tomorrow I have a great guest. It's first time Julia Cordova. And I mean, she is exuberant on Twitter about her trading, and she has a lot of fans. So I'm looking forward to our interview tomorrow. And enjoy the rest of your day, everybody. Don't just count your pips. Don't just think about history, but think about now and next. And if the darkness of depression begins to creep in, turn your eyes to the light of gratefulness. And I'm grateful for being part of the best team on the net and being able to talk to you guys every day and hope to help people. That's our goal here at ForexAnalytix, is to help you guys. Okay. All right. So that's a wrap. See everyone tomorrow. Thank you, Steve. And, I'm sure there's some stuff happening in the chat room. Okay. So I'm going to end it. Or Steve, maybe you could end it. I don't see the end meeting sign up here.
Let me see, Coach.
Here, let's see, view options. Yeah.
No, you're the host, actually.
And Steve, okay, my internet connection's unstable.
Okay.
Steve, all right.
I will reclaim host and close it. Okay. Bye-bye.
Thank you, buddy. See you, everyone.